I think my biggest fear for everybody here who is investing right now, and I'm not telling you to stop investing, I just want you to know that it's a risk factor that you should be aware of, is that almost all of you have never really seen a long, protracted bear market. The closest many of you have seen was in 2008 after the GFC. And by the way, even that was really short. It wasn't this, ironically, it wasn't nearly as bad as what it could have been or should have been. Just so you understand, when I was growing up, interest rates in the 70s were 22%. Let me repeat that. When I was growing up, interest rates were 20 plus 22, 23%, meaning that you could take your money and put it in a bank account and buy a CD that was insured by the federal government up to $100,000 and get 22% return on your money. What does that mean? I want you to think of this more deeply than just, oh, wow, it's really pretty cool. I can get 22%. What does it mean? What happens when interest rates are that high? It means that smart people with lots and lots of money say to themselves, why should I invest my money in the stock market where there's risk? Why not invest everything or the bulk of my assets in fixed income? If the interest rates are that high, I should be buying U.S. government bonds, treasury notes, T-bills, corporate bonds, commercial paper, CDs. People start going into fixed income investments because they're, for the most part, riskless or far less risky, especially if you're buying AAA rated stuff, the best stuff out there. And so just think, so what happens? In those situations, when we're in a very high interest rate cycle, money pours out of the stock market and goes into the bond market, into the debt market, which is much bigger actually than the stock market. That's what happens about municipal bonds, which are tax-free. So that causes what? It causes the triggering of a bear market. When interest rates go up that high, it causes a bear market. It's not in by itself the only causative factor, and interest rates can go up for a while, and a bear market can be held off for a while. But what happens when interest rates start to go up, it's not just that it gets more expensive for people to borrow money, which then slows down growth and leads to lower earnings for stocks, which then should theoretically depress the price of the stocks because stocks trade, or theoretically they're supposed to trade based on some semblance of what their future earnings are going to be. And ultimately that one day they might ever pay a dividend and people can get income from their stocks. That's what the market's based on. That's why people invest in the stock market, not just for speculation and short-term trading. They're buying based on what's called yield. What is my yield going to be? If one day I buy a stock and it pays a dividend, I got that yield locked in. So back in the days when we were dealing more in the reality of numbers, before the last couple of years, been like a disconnection a bit. People would buy things like utilities that had high yields. So older established investors would invest in these sort of fixed income securities, either bonds, corporate bonds, or utilities that paid a high dividend. And those were very, very safe investments. What happens is inflation and recession are these sort of two sides of the business cycle. So, you have recession on one side means a contraction of economic activity. And the opposite of that is called what? Expansion, right? A boom cycle. Sort of like, expansion means economics are great, companies are growing, the economies around the world, or at least domestically here in the U.S., if you want to take a U.S.-centric view of it, they're expanding and growing. That's expansion. Right? And then you have the recession on the other side. And then ultimately you could have depression, which is a really severe recession that is prolonged. And when growth, the number they use is a retraction of, I think it's 25% or more, is called a depression. So it's a massive contraction in economic growth.